Welcome to the debate. Today, we're diving straight into, a really foundational conflict in successful investing. It's this tension you see running through pretty much all the source material. On one side, you've got this idea of rigorous financial discipline. Dollar cost averaging, serious diversification, sticking to structured plans. And then on the other side, you have some pretty compelling historical evidence supporting methods that frankly challenge that very discipline. Think lump sum investing, concentration, trying to optimize things. So here's the core question, the real conflict in finance we're exploring. Is long-term investment success fundamentally driven by, let's say, superior psychological discipline, mastering our own emotions, or is it really about rigorous quantitative strategy, just maximizing capital efficiency based on the numbers? My position? It's pretty clear. Success absolutely hinges on psychological mastery. That behavior gap we read about, the underperformance caused by emotional decisions, that is the single greatest wealth destroyer out there. So consistency, that becomes the ultimate competitive advantage.
Well, I come at this from maybe a slightly different angle. I absolutely recognize the behavior gap is real. I mean, the data is there. But I believe that achieving true long-term outperformance really only comes through quantitative optimization, mathematical efficiency. It really has to lead the decision-making process. These disciplined strategies you mention, they often feel designed for wealth, the fearful investor, and they frequently fail to capture maximum growth precisely because of that inherent rigidity and, frankly, some significant opportunity costs. When the goal is optimal returns, the math, it just has to win out over emotional comfort.
Okay, but let's start with that emotional reality because I think it's critical. We can sit here and discuss theoretical returns all day long, but the greatest threat to actually accumulating wealth isn't market risk per se, it's the human brain, specifically how it's hardwired towards loss aversion and, of course, that debilitating fear of missing out, FOMO. And the reality here, it's quite staggering, and the data is really consistent on this. Studies referenced in our material, like the ones from Dalbar, they consistently show the average investor lagging way behind broad market indices, sometimes by 50% or even more over a 20-year period. Now, this huge gap, it's generally not because they picked terrible funds. It's because they panicked. They hit the sell button at the absolute worst time, or maybe they bought high fueled by greed.
And this is precisely why discipline is so paramount. Foundational systems like setting up an emergency fund, using a SMART framework for your goals, implementing dollar cost averaging. These aren't just, nice suggestions. They are fundamentally psychological tools. They're designed specifically to remove emotion from the execution phase, to force consistency, and to make sure the investor actually stays invested through what's inevitably a full market cycle. Your written plan, that discipline, it really serves as the emotional anchor when the financial seas inevitably get chaotic.
I'm sorry, but I just don't quite buy that the optimal investment strategy should be built around compensating for let's say, the weakest investor's potential psychological failings. It feels like you're focusing perhaps too much on the investor's potential flaws. I'm trying to focus on the capital's potential. Discipline, especially when it becomes rigid, can actively lead to suboptimal financial outcomes precisely because it prioritizes that emotional comfort over actual capital efficiency. Let's actually unpack the math here regarding your cornerstone of consistency, dollar cost averaging, or DCA. The historical data demonstrates pretty unequivocally that lump sum investing, LSI, outperforms DCA in roughly 2/3, maybe even up to 75% of historical scenarios. Right? The penalty for delaying investment through DCA is measurable. It yields on average maybe 2-3% less return simply because LSI captures that time in the market advantage immediately. By spreading out your investment, you are, in most cases, almost certainly leaving money on the table just for the sake of feeling a bit safer. And furthermore, consider the opportunity cost of the kind of discipline you're praising, like holding significant cash in an uninvested emergency fund. Look, if inflation is running at, say, 3%, and your high-yield savings account is maybe giving you 0.5% if you're lucky, that cash is actively losing 2.5 to 3.5% of its purchasing power every single year. That is a slow but certain erosion of wealth. So rigid preservation, while it might feel psychologically comforting, is demonstrably financially destructive over time.
Okay, I absolutely recognize the statistical validity of your point on LSI. I mean, the numbers are the numbers, but statistical validity means almost nothing when the behavior needed to actually execute it fails at the first sign of market stress. You're citing the mathematical superiority of LSI, but the real test isn't the percentage gain on paper. It's whether the average person can actually stick with that LSI investment after, say, a 30% drawdown. That's where the psychological edge just collapses for most people. DCA, on the other hand, is the mechanism that neutralizes the incredibly damaging effects of trying to time the market, which, as the material rightly calls it, is the most dangerous pursuit in investing. Consistency is absolutely key because, as research clearly shows, investors who try to time the market often miss the best trading days, and counterintuitively, those best days typically follow the very worst days. Missing just 10 of the best trading days over a couple of decades can slash returns by over 50%. DCA eliminates that internal debate, the emotional paralysis. It ensures continuous participation through the full cycle, automatically forcing the investor to buy low during periods of panic without having to consciously make that terrifying decision.
I take your point on the catastrophic risk of bad market timing, I do. But DCA's psychological safety net comes at a measurable, predictable financial cost in the vast majority of historical cases. It feels like you're focusing too much on avoiding the absolute worst potential drop, and by doing so, you're inherently missing out on the historically more frequent and more profitable average days the market delivers. For an informed investor, someone with a truly long time horizon, let's say a 25-year-old just starting their career, the decision to deploy capital immediately via LSI is, statistically speaking, superior. Their long investment window allows them to absorb volatility. By accepting that potential initial drop, the very discomfort you seem to fear, they capture the crucial time advantage that, over decades, historically leads to superior returns. The mathematical imperative for immediate capital deployment really should outweigh fear for anyone who has the appropriate risk capacity and time horizon.
I acknowledge that LSI statistically wins the starting line. Fair enough. But your optimization model seems to fail if it doesn't adequately account for risk management down the line. So let's talk about diversification. Disciplined investing absolutely mandates diversification to minimize that unsystematic risk, the risk tied to a specific company or sector failing. This is often called the only free lunch in investing, right? Because it allows you to potentially reduce risk without necessarily sacrificing expected returns. It's supposed to be the necessary shield, ensuring losses in one area might be offset by gains elsewhere.
See, this is where we fundamentally disagree. I really challenge the modern dogma of almost forced diversification because true, really outsized growth often comes from conviction and, yes, concentration. If an investor has genuinely done the homework, understands a company or a sector deeply, then overly diversifying actively harms their potential returns. I mean, look at what Warren Buffett famously said. Diversification is primarily protection against ignorance. And just look at recent market history. The whole Magnificent Seven phenomenon drove something like over 62% of market returns in 2023. Disciplined, broad diversification meant massive underperformance during that period of intense market concentration. If you dilute your best ideas across 500 different names, your big winners just get averaged down by hundreds of mediocre performers. Concentration, when done right, is the path to maximizing capital efficiency. And the most successful investors, Buffett is the prime example here, with his top 4 holdings making up over 70% of his public portfolio, they often maintain extreme concentration. That, historically, has been a path to exponential wealth creation.
Okay, I definitely see the appeal of trying to maximize those highly concentrated gains. I do. But the pursuit of that magnitude of outperformance, it's very often driven by overconfidence bias. And that bias, unfortunately, can lead to catastrophic loss when the inevitable happens, when a structural thesis about a company or sector fails. You cite Buffett, but let's be honest, he's an anomaly. He dedicates his entire life to deep fundamental research. For the rest of us, relying on discipline is almost mandatory for survival. We have countless historical examples. Think Nokia, Blockbuster, even previous tech giants that eventually became value traps, where concentration absolutely destroyed fortunes. So while a big structural shift, like the long-term potential of AI, for instance, might hold true, picking the single stock winner in that whole ecosystem, that remains highly uncertain. Discipline, I argue, mandates something like a core satellite structure. Maybe 70–80% in a passive core to capture broad economic growth and hedge against being wrong, while limiting those high conviction satellite bets to a much smaller percentage, perhaps 5–10%. That approach manages the risk while still allowing an informed investor to express that conviction. Crucially, it prevents one behavioral mistake, one wrong concentrated bet, from leading to utter ruin.
Managing the risk of ruin is valuable, I grant you that. But let's talk about the cost of the very rigidity you're defending. Your discipline framework relies heavily on things like a written plan, forced, preset rebalancing rules. I'd argue this rigidity can actually be highly destructive in dynamic financial environments. Think about it. The discipline of scheduled rebalancing often demands that you sell your appreciated assets, your winners, and buy into the deeply underperforming assets, your losers. That's inherently counter-momentum. Worse, forced rebalancing can actually lock in losses at market bottoms. We saw this dramatically during the 2008 crisis when asset correlations suddenly converged towards 1.0, meaning basically everything was selling off together, completely eliminating the diversification benefits right when you needed them most. Rigidity prevents necessary timely adjustments to structural shifts in the market or economy.
But that rigidity, that written plan, is precisely the investor's only defense against the inevitable impulse to make emotional, impulsive decisions when markets get truly chaotic. The discipline of scheduled rebalancing is essential because it forces the necessary but often psychologically painful action of buying low and selling high. Think of it this way. The written plan isn't just the suggestion. It's the financial equivalent of, chaining Odysseus to the mast. It prevents you from wrecking your financial ship when the sirens of fear and greed are singing their loudest. Without that preset discipline, an investor's innate loss aversion often prevents them from taking profits when they should, and their fear stops them cold from buying into underperforming assets when things look bleakest. The system, the discipline, it creates the desired behavior by overriding that flawed human emotion.
But that discipline framework seems to assume all investors are, relatively low skill and must be protected from themselves at all costs. For the informed, skilled investor, however, flexibility often generates superior returns. Sometimes, abandoning the old plan, recognizing conditions have fundamentally changed, is the most disciplined and profitable thing you can possibly do. Superior investment often requires conditional expectations, making decisions based on dynamic valuation metrics, on real structural shifts, rather than just blindly adhering to a calendar or an old target allocation set years ago. The rigidity you champion actively inhibits the ability to capitalize on new, crucial information. An informed investor who can adjust based on changing structural conditions, they can achieve a superior, more optimized return that the rigid, disciplined plan actively prohibits.
You're essentially trading potential capital gains for emotional comfort, and the truly informed investor shouldn't necessarily accept that penalty.
We still covered a lot of ground, and I just want to circle back to my original premise here. While quantitative optimization might offer some marginal theoretical outperformance on paper, the human psychological element, our own behavior, remains, I believe, the greatest determinant of final real-world returns. We know from research cited in the material that people with specific, written financial goals end up accumulating roughly 3 times the wealth of those without. That massive disparity isn't based on market timing skill, it's almost entirely based on discipline and behavioral consistency. So, discipline, consistency, and having that structured plan, they ensure the investor actually capturing something close to the market return, rather than falling victim to those catastrophic losses, often caused by loss aversion and FOMO.
I agree that the behavior gap is a significant factor. Absolutely. But I still maintain that genuine long-term outperformance is more likely achieved by adhering to statistically optimal strategies, things like lump sum investing where appropriate, strategic concentration based on deep conviction, and maintaining financial flexibility and accepting the volatility that comes with it. For an informed investor, the focus really must be on optimizing capital and seizing those high-conviction opportunities when they arise. Financial reality, the math, it must ultimately take priority over emotional comfort if maximizing returns is the goal. The reward for enduring that psychological discomfort is, historically, measurable, superior long-term wealth accumulation.
Well, our discussion today really underscores that core tension, doesn't it? The one that lies right at the heart of all successful investing. That fundamental conflict between what might be empirically superior in theory and what is actually behaviorally sustainable in practice for most human beings.
Indeed, and it really leaves the listener with that difficult but I think necessary choice, deciding which path, the disciplined fortress designed for psychological endurance or the optimized accelerator aiming for maximum speed, offers the best compromise for their own financial psychology, their own knowledge, and critically, their capacity to endure the inevitable market volatility. There's certainly always more to explore in this ongoing conflict.